Hey everyone, welcome back to Corporate Decoder. Today, BPA just filed a new administrative services agreement, and I am seeing some significant cost savings that matter. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is shifting its strategy, and this new deal could be a big win for investors if it plays out. This new filing from Bluerock Private Real Estate Fund, or BPRE as it is known on the New York Stock Exchange, is all about a new agreement that started on the 1st of July 2026. It is an administrative services deal with their investment advisor, Bluerock Fund Advisor LLC. Think of it like this, the fund used to invest a lot of money in other investment funds. These other funds had their own expenses, which ate into the returns that BPR investors actually got. Now BPR is moving more of its money into direct real estate investments. That is a big shift. When you own property directly, you don't have those other funds taking a cut. That's good news because it means more money can stay with the investors. But owning property directly requires a lot more work. You need people to manage joint ventures, handle property operations, deal with loans on those properties, manage legal stuff, keep track of REIT requirements, and do all the accounting and tax work for these direct investments. That is where this new agreement comes in. The advisor, Bluerock Fund Advisor LLC, is stepping in to handle all these extra tasks. This isn't just more of the same management they were already getting. These are brand new services specifically for the fund's direct real estate holdings. This includes things like making sure they are still listed on the New York Stock Exchange correctly, managing shareholder meetings, and handling all the necessary government reporting. Now, for all these extra services, the fund will pay the advisor a fee. This fee is set at 0.20% of the fund's average managed assets. Managed assets include everything, the fund's actual value, any money they've borrowed, and any preferred stock that is out there. This fee starts on the 1st of July and is paid monthly. Here is where it gets really interesting for investors. The advisor knows that the old way of investing had a lot of expenses. Even though they're now providing all these new services, they are voluntarily waiving almost half of the new fee. They're waiving an amount equal to what would have been charged on the money the fund had tied up in those old. Expensive investment funds as of the 1st of July, this waiver means they are effectively giving up about 53% of the fee they could have charged. This is a smart move to make sure the cost savings from the strategy shift actually reach the investors. It shows the advisor is aligned with the fund's goals. This agreement is pretty flexible. It can be ended with 60 days notice by the fund's board, the shareholders, or the advisor themselves, with no penalty. Any changes to the agreement need approval from the board, including the independent members. And on top of this new administrative deal, the fund also gave an update on its move into direct real estate. This is where the strategy shift is really happening. They're not just talking about it, they're doing it. As of the 1st of July, they had already closed about $250 million in direct real estate deals, and they have another $450 million in properties that are either under contract or being looked at closely in their pipeline. That's a significant amount of money being moved into direct ownership. This is a big deal for a company in the real estate fund space. The actual agreement is filed as an exhibit along with this report. This is the document that lays out all the specifics of what the advisor will do and what the fund will pay. The report is signed by Jordan Ruddy, president. So what is the big picture here? Bluerock Private Real Estate Fund is making a strategic pivot. They're moving away from more expensive indirect investments and into direct property ownership. This new administrative services agreement is key to making that transition smooth and cost effective. The fact that the advisor is waiving a large portion of their fee shows good alignment with shareholders and a commitment to passing cost savings on. The company is actively executing its strategy with a substantial amount already invested or in the process of being invested in direct real estate. This move has the potential to increase returns for investors by cutting out layers of fees at the underlying fund level. However, the success will hinge on the fund's ability to effectively manage these direct real estate assets. The new services are designed to cover this, but execution is always key. The risk I am watching is how well they can actually manage these properties. Direct real estate brings its own set of challenges and requires different expertise than managing fund of funds. What I'm actually looking for is how this new structure impacts their net asset value and investor distributions over the next few quarters. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you like this video, please hit like and subscribe for more deep dives and join us on Discord.